In this episode, we are going to look at the preparation of a flexible budget. To prepare a flexible budget for different activity levels, we must know how costs behave with changes in activity levels. Total variable costs change in direct proportion to changes in activity. The greater the activity or the greater the sales, the greater total variable costs become. Total fixed costs, however, remain unchanged when we're within a relevant range. In other words, within a certain level of activity range, fixed costs will not change as sales fluctuate. Knowing this cost behavior helps us prepare the flexible budget. So in order to prepare a flexible budget for ABC Company, we know that they budget to sell each unit for $10, and they budget variable costs per unit of $4.80 and a contribution margin of $5.20 per unit sold. Total fixed costs are budgeted to be $40,000. We always express variable cost as a constant amount per unit. So here we can see them preparing a budget for 3 different levels of activity. Preparing a budget for 10,000 units requires us to take the budget of 10,000 units times the budgeted selling price per unit to get budgeted revenues for sales of 10,000 units. We take the budgeted level of sales times the variable cost per unit to get the total variable cost budgeted per unit. We do the same thing for a 12,000 unit budget. Number of units budgeted times the selling price per unit to get total budgeted revenues when 12,000 units are sold. Total number of units budgeted 12,000 times the variable cost per unit to get total variable cost budgeted for sales of 12,000 units. We could repeat this process for 14,000 units sold. The fixed costs, however, do not change between the different levels of activity. Because recall, fixed costs do not change as the level of activity changes. They budget $40,000 in fixed costs whether they sell 10,000 units, 12,000 units, or 14,000 units. So now, when we look at the variances between the budget and the actuals, we are seeing variances that are caused not because the level of sales between actual and budgeted results are different, but because the selling price per unit or the cost per unit or total fixed cost were different from the budget. Unfavorable cost variance indicate costs are greater than expected. Favorable variances indicate sales were greater than the budget, contribution margin was greater than budget, income was greater than budget, which is positive. We want those items to be greater than budget.